For much of modern economic history, long-term planning was not an abstract ideal. It was a practical necessity. Governments, businesses, and households made decisions based on time horizons measured in decades, not quarters. Growth strategies assumed continuity. Infrastructure was built to last generations. Firms invested with the expectation that returns would arrive slowly but steadily. In the decades following World War II, this mindset was embedded across advanced economies. Governments committed to large-scale infrastructure projects, highways, power grids, public housing, water systems, with timelines spanning 20 to 40 years. Businesses expanded capacity with long payback periods, confident that demand, wages, and population growth would support those investments. Households planned careers, savings, and family life around relatively predictable economic trajectories. This long-term orientation was supported by the structure of the economy itself. Productivity growth was strong. Demographics were favorable. Financial systems were regulated and comparatively conservative. Capital was patient because alternatives were limited. Returns came from building things, not flipping them. Crucially, economic risk was distributed over time rather than concentrated in the present. Short-term volatility existed, but it did not dominate decision-making. Policy was judged by its durability rather than its immediate market impact. Stability was a byproduct of growth, not its replacement. This environment made long-term planning rational. It wasn't optimism, it was alignment. The economy rewarded patience because productive investment paid off. Institutions were designed to think ahead because the future felt reachable. That alignment began to weaken in the 1970s as productivity slowed, inflation rose, and growth became harder to sustain. What followed was not an abandonment of long-term goals, but a gradual erosion of the conditions that made long-term planning affordable. If you value long-form analysis that explains how economic behavior changes over time, consider subscribing and sharing your thoughts in the comments. Because once the future became harder to rely on, economic decisions began to pull forward, and time horizons started to shrink. As the conditions that supported long-term planning began to weaken, uncertainty quietly moved to the center of economic decision-making. This wasn't sudden chaos or crisis. It was a gradual realization, beginning in the 1970s, that the future could no longer be treated as a stable extension of the present. Planning ahead became riskier, and eventually more expensive. The sources of this uncertainty were structural. Productivity growth slowed across advanced economies. Inflation disrupted price signals. Energy shocks exposed dependence on volatile inputs. Demographic trends began to shift. At the same time, policy frameworks changed. Governments prioritized inflation control and short-term stabilization over long-term expansion. Financial markets became more influential, faster moving, and more sensitive to news and expectations. For businesses, this altered the calculus of investment. Long-term projects require confidence not just in demand, but in policy, costs, and financing conditions years into the future. As volatility increased and policy horizons shortened, that confidence eroded. Firms began favoring investments with quicker payback periods and more flexibility. Capital became mobile rather than committed. Financial systems reinforced this shift. Deregulation and globalization expanded the range of short-term opportunities. Returns could be generated through trading, arbitrage, and financial restructuring faster than through building capacity. The opportunity cost of patience rose. Waiting 10 years for returns looked less attractive when returns could be realized in months. Households experienced the same pressure differently. Job security weakened. Wages became less predictable. Housing and education costs rose faster than incomes. Planning decades ahead felt increasingly fragile. People adjusted by prioritizing near-term security over long-term ambition. Saving, career choices, and family decisions became more cautious and compressed. Governments faced their own version of this constraint. Electoral cycles shortened effective planning horizons. Policy success was judged by immediate outcomes, market reactions, employment numbers, fiscal balances, rather than long-term capacity. Infrastructure and institutional investment, with benefits far beyond political terms, became harder to justify. This is how uncertainty made the future expensive. It raised the discount rate applied to long-term outcomes across the economy. The future mattered less because it felt less reliable. Decisions shifted toward the present, not out of impatience, but out of adaptation. If this perspective helps explain why planning ahead feels harder today, consider subscribing and sharing your thoughts below. Because once the future became more uncertain, the next shift followed naturally. Financial markets began rewarding short-term outcomes far more aggressively than long-term ones. Once uncertainty made the future more expensive, financial markets became the place where that uncertainty was priced most aggressively. This is where time horizons began to shorten, not just by necessity, but by incentive. Markets started rewarding outcomes that arrived quickly, visibly, and measurably, and penalizing those that required patience. This shift accelerated during the 1980s and 1990s as financial markets expanded and became more liquid. Trading volumes increased. Information traveled faster. Performance was evaluated continuously rather than periodically. Quarterly earnings, share prices, and market reactions became central reference points for success. Long-term outcomes still mattered in theory, but short-term signals increasingly dictated behavior. Corporate governance adapted accordingly. Executive compensation became tied more closely to stock performance. Firms were judged by near-term metrics rather than long-term capacity. Investment strategies shifted toward actions that produced immediate valuation effects, cost reductions, restructuring, buybacks, rather than projects with distant payoffs. This wasn't a moral failure. It was a rational response to incentives. Capital allocation followed the same logic. Financial markets favored flexibility and liquidity. Assets that could be easily revalued and exited attracted more capital than long-term illiquid investments. Infrastructure, research, and workforce development struggled to compete with activities that delivered faster returns. The market did not eliminate long-term investment, but it discounted it heavily. This dynamic reshaped risk-taking. Short-term risks were tolerated if they promised immediate rewards. Long-term risks were avoided because they were harder to price and harder to exit. Over time, the economy became optimized for responsiveness rather than durability. Importantly, this shift fed back into expectations. When markets reward short-term outcomes, planning horizons compress across the system. Businesses, policymakers, and households internalize the same signals. What is rewarded gets repeated. If this analysis resonates, consider subscribing and sharing your perspective in the comments. Because once markets reward short-term outcomes, the next question becomes unavoidable: how long-term investment itself begins to disappear. Once markets consistently rewarded short-term outcomes, long-term investment did not vanish overnight. It was crowded out. Projects with long timelines, uncertain returns, and delayed payoffs gradually lost priority. The economy did not stop investing. It began investing differently, favoring speed, flexibility, and reversibility over durability and capacity. This shift was especially visible in corporate investment behavior. Firms became more cautious about committing capital to projects that would only pay off years later. Large infrastructure investments, research-heavy initiatives, and workforce development programs were increasingly viewed as risky, not because they lacked value, but because their returns were too distant to justify under short-term evaluation frameworks. Capital budgets tightened. Time horizons compressed. Public investment followed a similar path. Governments faced growing pressure to demonstrate immediate results. Infrastructure projects with long planning phases and delayed benefits became politically difficult. Maintenance was deferred. New construction slowed. Spending increasingly favored programs that produced visible outcomes within electoral cycles. Over time, public capital stock aged, even as economies grew larger and more complex. Financial markets reinforced this pattern. Investors favored assets that could be priced and traded easily. Long-term projects tied up capital without offering liquidity. Pension funds and institutional investors, despite having long-term liabilities, faced performance benchmarks that encouraged short-term optimization. The mismatch between investment needs and incentive structures widened. This crowding out effect had cumulative consequences. Productivity growth slowed as capital deepening weakened. Innovation diffusion lagged. Infrastructure bottlenecks emerged. The economy became more efficient at reallocating existing assets than at building new ones. Crucially, this process was subtle. There was no sudden collapse in investment. Instead, each decision slightly favored the short term. Over decades, these marginal choices added up. The economy retained the appearance of sophistication while losing its capacity for renewal. If this explanation helps clarify why long-term investment feels scarce despite abundant capital, consider subscribing and sharing your thoughts. Because once long-term investment declines, the next effect becomes unavoidable. Planning itself starts to lose credibility. Once long-term investment began to fade, something deeper changed. Planning itself started to lose credibility. This was not because planners became less capable or because societies stopped valuing the future. It happened because long-term plans were increasingly undermined by conditions beyond the planner's control. When plans repeatedly failed to materialize, trust in planning eroded. In earlier periods, long-term plans were credible because the environment supported them. Growth trends were stable. Policy frameworks were predictable. Financing conditions were durable. When governments announced infrastructure programs or industrial strategies, businesses and households believed those commitments would hold. The future felt governable. As time horizons shortened, this assumption weakened. Policies changed more frequently. Funding commitments were revised or reversed. Projects were delayed, scaled back, or canceled. Long-term plans became contingent on short-term conditions, market reactions, fiscal constraints, political cycles. Planning documents multiplied, but execution lagged. Businesses adapted quickly. Instead of relying on long-term projections, firms emphasized optionality. They structured investments to be paused, reversed, or exited. Strategic planning shifted from defining a destination to managing scenarios. Flexibility replaced commitment as the primary objective. Households internalized the same lesson. Long-term decisions, education paths, career development, family planning felt increasingly exposed to forces beyond individual control. Planning ahead became an exercise in risk management rather than aspiration. People prepared for disruption rather than progress. Governments faced the most visible credibility gap. Large projects required years of coordination, yet political authority rotated every few years. Each transition introduced uncertainty. Long-term strategies were announced, but rarely completed under the same leadership. Over time, skepticism grew. Plans were treated as signals rather than promises. This erosion of credibility mattered because planning relies on trust. When trust weakens, coordination breaks down. Individuals and institutions retreat into shorter horizons because collective commitment feels unreliable. The economy becomes reactive rather than directional. If this perspective resonates, consider subscribing and sharing your thoughts below. Because once planning loses credibility, the next shift becomes unavoidable. Coordination across society begins to break down. Once planning lost credibility, the effects spread beyond individual decisions and into the fabric of the economy itself. Coordination began to break down. Long-term growth depends on many actors moving in the same direction. Governments building infrastructure, firms investing in capacity, workers acquiring skills, and financiers providing patient capital. When time horizons shorten, that alignment becomes difficult to sustain. In earlier periods, coordination emerged naturally because incentives were aligned. Governments committed to long-term projects. Businesses invested knowing demand would follow. Workers trained for careers that would exist decades later. Each group acted independently, yet their actions reinforced one another. Growth was cumulative. As planning credibility weakened, these feedback loops unraveled. Governments hesitated to commit to projects without immediate payoff. Businesses delayed investment without policy certainty. Workers avoided specialization without employment security. Financiers preferred liquid assets over long-term commitments. Each decision made sense on its own, but collectively they produced drift. This breakdown was most visible in areas requiring multi-decade coordination. Infrastructure networks lagged behind economic needs. Housing supply failed to keep up with demand. Energy transition stalled. Education systems struggled to anticipate labor market requirements. The economy became reactive, addressing shortages after they emerged rather than preparing in advance. Financialization intensified the problem. Markets rewarded individual performance, not collective outcomes. Capital flowed towards sectors offering immediate returns, regardless of broader economic needs. Coordination failures were not penalized by markets because their costs appeared slowly and diffusely. By the time consequences emerged, responsibility was hard to assign. Political systems mirrored this fragmentation. Policy debates focused on near-term distribution rather than long-term capacity. Coalitions formed around immediate interests. Cross-generational planning weakened. The future became a contested space rather than a shared objective. The result was an economy capable of responding quickly to shocks, but poor at building toward common goals. Flexibility replaced direction. Adaptation replaced ambition. Growth persisted, but without a clear trajectory. If this analysis helps clarify why large-scale challenges feel harder to address today, consider subscribing and sharing your perspective. Because once coordination breaks down, the next question becomes unavoidable. How short time horizons reshape risk, resilience, and vulnerability across the system. Once coordination across the economy weakened, the nature of risk began to change. Shorter time horizons didn't eliminate risk, they repackaged it. Systems optimized for immediate responsiveness became less prepared for slow-building threats. Resilience improved against short-term shocks, but vulnerability increased to long-term stresses. In earlier growth models, risk was managed through redundancy and preparation. Infrastructure was built with excess capacity. Supply chains prioritized reliability over efficiency. Public institutions maintained buffers. Now, these choices looked inefficient in the short run, but they absorbed shocks over time. Long-term planning made resilience affordable. As time horizons shortened, these buffers were gradually removed. Lean systems were rewarded. Just-in-time logistics replaced inventories. Infrastructure maintenance was deferred. Financial balance sheets were optimized for return rather than durability. Each change improved short-term performance while reducing margin for error. Financial markets reinforced this trade-off. Risk models focused on near-term volatility rather than structural exposure. Rare events were discounted because they lay beyond typical planning windows. When risks were not immediately priced, they were ignored. Over time, systemic vulnerabilities accumulated beneath the surface. This dynamic reshaped crisis response. When shocks occurred, systems reacted quickly but expensively. Emergency interventions replaced preparation. Stability was restored after disruption rather than preserved in advance. Each crisis justified further short-term optimization, reinforcing the cycle. Households experienced this shift as well. Financial resilience declined even as income stabilized. Savings rates fell, debt exposure increased, security depended on continuous income and asset values. When disruptions occurred, households had less room to absorb them. The paradox of shortened time horizons is that they create fragile resilience. Systems appear robust under normal conditions, but fail abruptly under stress. The economy becomes better at surviving small disturbances and worse at managing large ones. If this framing resonates, consider subscribing and sharing your thoughts in the comments. Because once resilience becomes fragile, the next issue becomes unavoidable: how policy adapts when prevention gives way to constant intervention. Once resilience became fragile, economic policy adapted in a predictable way. Prevention gave way to intervention. Instead of building systems designed to withstand stress over time, policymakers increasingly focused on responding quickly after disruptions occurred. The shift did not reflect poor judgment. It reflected constrained time horizons and political reality. Preventive policy requires long planning windows, upfront costs, and benefits that arrive years later. It demands coordination across institutions and continuity across governments. In a short horizon environment, these conditions are difficult to meet. Intervention, by contrast, delivers immediate, visible results. It can be deployed quickly, targeted precisely, and adjusted in real time. Over time, intervention became the default mode of economic management. This transition became especially visible after the 2008 financial crisis. Rather than restructuring financial systems to reduce future fragility, policy focused on stabilizing markets and restoring confidence. Emergency measures worked, collapse was avoided, but the underlying approach shifted. Future risks were managed through the expectation of rapid response rather than structural resilience. Central banks expanded their role dramatically. Monetary policy moved beyond rate setting into asset purchases, liquidity provision, and market backstopping. Fiscal policy followed a similar path. Governments relied more heavily on stimulus, guarantees, and targeted support during downturns. Each intervention was justified, often necessary, but together they reinforced a reactive framework. This approach changed incentives. If severe disruptions would be met with intervention, the urgency of prevention diminished. Long-term investments in resilience remained on policy agendas, but they competed poorly with short-term responses. Over time, emergency tools became semi-permanent features of the system. Intervention-focused policy also altered public expectations. Stability was no longer assumed to come from preparation. It was expected to arrive through response. Markets, businesses, and households adapted accordingly. Risk-taking increased where intervention was anticipated. Vulnerability accumulated where prevention was neglected. The economy became highly capable of crisis management, but less capable of crisis avoidance. This is not inherently unsustainable, but it is costly. Each intervention draws on fiscal capacity, institutional credibility, and political trust. The more frequently it is required, the harder it becomes to maintain. If this analysis adds clarity, consider subscribing and sharing your perspective. Because once policy relies on constant intervention, the next question becomes unavoidable. How long-term capacity erodes quietly in the background? Once policy shifted from prevention to constant intervention, a subtle but critical change followed. Long-term economic capacity began to erode in the background, largely unnoticed. This erosion did not trigger headlines or immediate crises. Instead, it unfolded slowly, masked by stability, activity, and repeated short-term recoveries. Long-term capacity refers to an economy's ability to grow without extraordinary support. It includes productive infrastructure, skilled labor, institutional competence, innovation ecosystems, and social trust. These elements are built over decades and degrade gradually. When policy focuses on intervention rather than preparation, capacity is consumed faster than it is replenished. Public infrastructure illustrates this clearly. Maintenance was deferred because it produced no immediate political reward. New projects were delayed because they required long planning horizons and coordination. Over time, infrastructure aged, bottlenecks formed, and efficiency declined. The economy continued functioning, but at higher cost and lower reliability. Human capital followed a similar path. Education and training systems struggled to adapt to changing needs. Skills mismatches persisted. Long-term workforce development lost priority to short-term labor market fixes. Productivity did not collapse, but it failed to accelerate. Each year's shortfall seemed small. Over decades, the loss compounded. Institutions also weakened quietly. Agencies optimized for rapid response rather than strategic planning. Institutional memory shortened as priorities shifted frequently. Policy expertise became fragmented. The system remained active but less coherent. Capacity to design and execute complex, long-term initiatives declined. What made this erosion difficult to detect was that intervention worked repeatedly. Each crisis was managed. Each downturn was softened. Markets recovered. Employment rebounded. These successes reinforced confidence in the approach. But intervention draws on existing capacity. When capacity is not renewed, each response leaves the system slightly weaker. This creates a dangerous illusion: stability without strength. The economy appears resilient because it survives shocks, but its ability to generate growth independently diminishes. Over time, intervention becomes more frequent and more intense, not because shocks increase, but because capacity has thinned. If this explanation helps clarify why economies feel increasingly dependent on policy support, consider subscribing and sharing your thoughts below. Because once long-term capacity erodes quietly, the final question becomes unavoidable. What kind of future does an economy with shortened time horizons ultimately create? Once long-term capacity erodes quietly, the consequences eventually surface, not as a single crisis, but as a changed future. An economy shaped by shortened time horizons does not suddenly stop functioning. Instead, it settles into a different equilibrium, one where progress is slower, adjustment is harder, and ambition is constrained by the need to avoid disruption. In this kind of economy, growth continues, but it is thinner. Output rises, but gains are uneven and fragile. Living standards improve for some, stagnate for many, and decline in relative terms for others. The system becomes increasingly dependent on favorable conditions, low interest rates, stable asset prices, external demand, to maintain momentum. When those conditions weaken, stress emerges quickly. Decision-making reflects this fragility. Governments prioritize policies that preserve stability in the near term, even if they weaken long-term potential. Businesses favor strategies that protect margins rather than expand capacity. Households plan defensively, focusing on security rather than opportunity. None of these choices are irrational. They are adaptive responses to an environment where the future feels uncertain and expensive. The most important consequence is path dependence. Once time horizons shorten, reversing the process becomes difficult. Long-term projects require coordination, trust, and patience, all of which are scarce in systems optimized for immediacy. Each year of short-termism makes the next year harder to plan for. The economy adapts, but to a lower ceiling. This does not mean collapse is inevitable. Many economies can persist in this state for decades, but the cost is cumulative. Infrastructure gaps widen, productivity underperforms, innovation diffuses slowly, social cohesion weakens. The economy remains busy, yet struggles to move forward. Understanding this outcome reframes the debate about modern growth. The central challenge is not a lack of ideas or resources, but a mismatch between the time horizons required for progress and the time horizons rewarded by the system. Until that mismatch is addressed, long-term planning will remain fragile. To understand how we arrived here and how financial priorities reshaped growth expectations in the first place, let's watch our previous video, How Financialization Changed the Meaning of Growth, and without anyone voting for it. If you value long-form system-level economic analysis that explains not just what is happening, but why it unfolded this way, consider subscribing. Sharing your thoughts in the comments and staying with us as we continue exploring how modern economies quietly change over time.